Identifying and Trading Forex Divergence Patterns. Introduction. Divergence is a powerful technical analysis concept used by Forex traders to identify potential trend reversals or trend continuation signals. Divergence occurs when the price of a currency pair and an oscillator indicator, such as the Moving Average Convergence Divergence (MACD) or the Relative Strength Index (RSI), move in opposite directions. Intermediate Forex traders often find divergence patterns valuable for making well-informed trading decisions. In this text, we will explore how to identify and trade Forex divergence patterns, highlighting their significance and potential benefits. Understanding divergence in Forex trading. Divergence occurs when there is a discrepancy between the price action of a currency pair and the readings of an oscillator indicator. It can be either positive, bullish divergence, or negative, bearish divergence. Bullish divergence. Bullish divergence happens when the price forms a lower low, but the oscillator indicator forms a higher low. This suggests that the downward momentum is weakening, and a potential bullish reversal may occur. Bearish divergence. Bearish divergence occurs when the price creates a higher high, but the oscillator indicator forms a lower high. This indicates that the upward momentum is weakening and a potential bearish reversal may be on the horizon. Identifying divergence patterns. To identify divergence patterns, follow these steps. Select an oscillator indicator. Choose a reliable oscillator indicator such as the MACD, RSI, stochastic oscillator, or the Moving Average Convergence Divergence histogram, MACD histogram. Analyze price and indicator movements. Compare the peaks and troughs of the price action with the corresponding highs and lows of the oscillator indicator. Look for instances where the price and the indicator move in opposite directions. Confirm with trend lines. Draw trend lines connecting the peaks and troughs on the price chart and the corresponding highs and lows on the oscillator indicator. Confirming divergence patterns with trend lines can provide additional validation. Trading strategies for divergence patterns. Bullish divergence trading strategy. Identify a bullish divergence pattern, lower low on price chart and higher low on the oscillator indicator. Wait for a confirmation signal, such as a bullish candlestick pattern or a break above a key resistance level. Enter a long, buy trade with a stop loss below the recent swing low. Set a take-profit target based on technical analysis, such as a previous high or a Fibonacci extension level. Bearish divergence trading strategy. Identify a bearish divergence pattern, higher high on price chart and lower high on the oscillator indicator. Wait for a confirmation signal, such as a bearish candlestick pattern or a break below a critical support level. Enter a short sell trade with a stop loss above the recent swing high. Set a take-profit target based on technical analysis, such as a previous low or a Fibonacci extension level. Combining divergence with other indicators. Divergence patterns can be more powerful when used in conjunction with other technical indicators and chart patterns. For example, support and resistance. Confirm divergence patterns with key support and resistance levels to enhance the accuracy of potential entry and exit points. Moving averages. Use moving averages to identify the overall trend direction and assess the strength of the divergence signal. Candlestick patterns. Combine divergence patterns with candlestick patterns to time entries and exits more effectively. Risk management. As with any trading strategy, risk management is essential when trading divergence patterns. Use appropriate position sizing, set stop-loss levels to limit potential losses, and consider using trailing stops to protect profits as the trade moves in your favor. Conclusion. Identifying and trading Forex divergence patterns is a valuable skill for intermediate traders seeking to identify potential trend reversals and continuation signals. Bullish divergence indicates a weakening downtrend and a potential bullish reversal, while bearish divergence signals a weakening uptrend and a potential bearish reversal. By combining divergence patterns with other technical indicators and confirming signals, traders can enhance the accuracy of their trading decisions. Implementing effective risk management techniques is crucial to managing potential losses and maximizing profits. As with all trading strategies, practice, experience, and continuous learning will contribute to the mastery of trading divergence patterns in the dynamic and ever-changing Forex market.